Hello and welcome to a special episode of the Biz News Briefing from the team at biznews.com. I'm Lucy Ferreira and today is the 24th of August. It's a Wednesday. Alec Hogg and I are joined in studio by one of Biz News' favorite guests, independent financial advisor and director of Brenthurst Wealth Management, Magnus Heystek. Magnus, thank you for being with us today.
Always a pleasure, Lucy. Nice to talk to you.
It's lovely to have you. In today's show, we'll be having a look at the latest in the markets and focusing on the explosive claims made by Sean Peche, criticizing South African asset managers and their performance fee structures, which is where Magnus's insights become especially handy for us. We'll also be hearing from the FT with the coverage of the recent allegations made against Twitter by their former security chief and what this could mean for Elon Musk's interests. I think it's going to be a very juicy show. Alec, before we go there, tell us what's been happening in the markets today.
Yeah, it is going to be a juicy show indeed. And Magnus, always lovely to have you with us, particularly in our Biz News briefing. Well, in the markets today, the big news in South Africa was that the inflation rate came out. There's all kinds of panic in the media. It's a 13-year high, 7.8%. Hang on a minute, guys. The United States for the same month was 8.5%. And the UK is at 10.1%, and they projected to get to 18% later in the year. So yeah, South African inflation is higher, but no need to panic, certainly relative to those other countries. And interestingly enough, the Rand spoke to that figure as well. The Rand today was stronger against the US dollar. We picked up from 17.09 yesterday to 16.94. It picked up 12 cents against the pound at 20.01. No more of those lucky strikes, Magnus. I think you need to switch to something like Benson and Hedges, eh? And the euro, 7 cents firmer at 16.91. So ignore the panic headlines. The Rand actually performed correctly, or it improved on those inflation figures. JSE today, a bit mixed, not really a lot to write home about. The top 40 index down by 0.1%. The industrials were a little firmer. They're up 0.5%. Resources down 0.5%. Financials down by just under 1%. As far as the movers are concerned, we had information coming out from Blue Label. Remember, they're in the process of recapitalizing Cell C. You've got to wonder what the chances of Cell C are, given that Telkom is now very much in play, maybe going to become part of MTN, maybe merging with Paul Harris's reign. Well, Cell C, they're going ahead, Blue Label. They're still putting money into it. The announcement today said that they have now got binding long-form agreements which are expected to be completed in their entirety shortly. They believe that the process will be concluded by the middle of September, and the shares are up 2%. The big news from overseas, and this I must... our colleague Danita DeCania. Mm-hmm. Now, her dad, Manny DeCania, is a good pal of mine. And he's been telling me to buy Farfetch shares for a while. Why? Because Manny's Portuguese, and the guy who owns Farfetch is the Portuguese Steve Jobs. This is what he tells me.
Some insider trading there.
It's full-on insider trading. And so the Portuguese Steve Jobs today did a deal with the South African Johan Rupert, the real Johan Rupert. And Richemont is going to sell its share in Net-a-Porter to Farfetch, the same company, which is then going to be managing the back end of the online luxury goods portal. How Richemont wins here, it picks up 10% initially of Farfetch, maybe 20% later on, and the platform becomes neutral. So other luxury brands will come in as well. It's very interesting. I was reading a book on Amazon recently where they highlighted Richemont's efforts in digital online sales as being one of the very, very few where Amazon has failed when they've taken them on. So good luck to Manny, good luck to Farfetch, the Portuguese Steve Jobs, and the Farfetch share price today went up 25%. Richemont's share price was up by 2.8% on the JSE. Farfetch is not listed here. The other story was Bidcorp was up 2.8% on results. Anglo Platinum up 3%. Sasol continues to improve after the results yesterday, 2.3% higher. On the way down, Aspen, their results are no longer happy to the market. That's down 3%. Anglo 2.5% today. Harmony 2.5%. And Standard Bank continues to slide. It's off another 2% today.
And here's Sean Peche's clip.
Now, what I did, Alec, is I looked at the fee structures of the 10 largest non-income funds in South Africa. So I took the income funds out of the equation. And what I found was that 83% of assets under management for those funds have performance fee structures. I then looked at the top 10 largest non-income funds in the UK, and not a single one had performance fee structures. Now, this is a quote from Mr. David Smith, who is formerly Citywire's investment editor. He's now a fund manager at Hargreaves Lansdowne, which has 120 billion in assets under management. And it is the largest platform for private investors. You can go on there, you can buy funds, you can buy stocks around the world, you can do whatever you want. Okay, this is what he said. He said, today, most fund managers with such a fee structure, performance fees, cannot even get a foot through our door. Now, what was scary is he said that 9 years ago.
So just unpack that quickly. In South Africa, 83% of funds have performance fees, which 9 years ago, David Smith was saying you wouldn't be able to do business in the UK. And today, indeed, there are no major funds that have got performance fees in the UK. Well, why would this be the case?
Well, firstly, just to say it's 83% of assets under management. I haven't been through all the 1,300 funds in South Africa. Why would be the case? Because they're complicated structures and you're selling to retail investors. Now, here's the scary thing, Alec. The weighted average of the top 10 funds in South Africa, non-income funds, the fee, TER, 1.5%. In the UK, less than 0.5%.
Magnus Heystek. I mean, that is really heavy stuff. Just starting off with this thing called performance fees. 83% of South Africa's biggest funds charge them. In the UK, they wouldn't get away with that. But then that last point he talks about, the total expense ratio of South Africa's fees, South Africa's unit trusts 1.5% as against 0.5% in the UK. Someone's getting ripped off here, Magnus.
Well, yes, Eric, that kind of, I mean, Sean's piece is a brilliant piece, and the interview you did was fantastic. And he highlighting, shining the torch where the local asset management companies would not like anyone to go and shine. And I think it's part of the reason why there's such or has been such a massive pushback from people who say, take some money offshore because it's so much cheaper and the returns are so much better. The local asset management companies, especially the big five, I mean, are massive profit generators. And Sean, in fact, focused on some of the better performing ones. He didn't even get to the old staid life insurance companies who's in the same boat, and their fee structures are even higher. I mean, I often point out, returns from Old Mutual Investors Fund, which is their flagship fund. Some periods of time, they've made more money than the investor. Over 5 years, the returns currently is like 3.9%. If you strip out inflation and the advisory fees and the platform fees, the last 5 years, you've lost 3% of your money, yet nobody seems to be pulling money out of that fund or any of these large funds. I simply cannot understand that. But I think, and I spent some time considering it, I mean, it's especially the tied agents working for these big corporations who are dependent on new business leads from these big companies. Being a tied agent, you have to sing for your supper. You have to spin a fantastic story about why you should invest in this company or why you should not pull your money out because, things are getting better and you're going to miss the upturn. But it all boils down to the massive profits that these companies are making. And the average man in the street who's trying to just build up a little bit of a portfolio is being hammered. I mean, I look at these numbers all the time, Alec, and I've commented frequently. The last 10 years, the average investor, whether unit trusts or endowments or RAs, has made no money after taxes and inflation. He's made no money. Now, that's a massive statement to make, but go and scratch around. I've got a schedule in front of me, and I looked at most of the returns over 5 to 7 to 10 years after inflation and taxation have no real growth.
Yeah.
So, but yet people are so loyal to the brand and the power of the brand and the power of persuasion by the agent. They seem powerless to do something about that. And I hope that's what Sean has done with his expose and your expose on, goodness gracious, why do you pay so much money for underperforming fees? For funds, you can get them half the price and the returns are just so much better. So it was a great piece of journalism. Alec, I must compliment you.
There were two big things that jumped out at me. And by the way, although the investors haven't done well over the past 10 years, the asset management companies have certainly done very well, as we see from these billions and billions that they're taking from the investors' funds. But 2 points, and I'd love to get your thoughts on it. The one was the performance fee, which is not charged elsewhere in the world, but is charged in South Africa. It gets worse because that's based on a benchmark that these companies, and Sean mentions, and he gives the data, Allan Gray, Coronation, 91, the big three. He says that they just decide what benchmark they want to put there. So in other words, in one of the funds, he said they have a benchmark of their peers. And in other words, if the peers went down, which they did, they lost money. These guys still also lost money, but not as much as the other so-called peers lost. And they then, on top of the normal fees that they charged a performance fee. Now that's outrageous. If you lose money for somebody who gives money to you to align your interests, presumably, and you then charge them a performance fee for losing money, Magnus, where else in the world do you get away with this kind of behavior?
This thing has been bubbling under the surface for a long time. I can't recall exactly when Allan Gray changed their performance fee formula, but it was about 5-6 years ago. It was it was far fairer towards the client than it used to be. Then they changed it to the average of their peers, excluding their own fund. But their own fund made up about 60% of the index. And as you point out, you could lose money, but because you lost a little bit less than your peers, you can then go and charge a performance fee, which is iniquitous. You won't find any Allan Gray funds in our portfolios. I mean, for a variety of reasons, the fees have been one, and it's just iniquitous how they've just changed it. And the average investor and plus many advisors simply don't understand. As Sean tried to explain, he tried to read it for you to understand. You need to be a super actuary to understand the longer-term implications of the way they calculate the performance fees. I mean, now you can compare that with a guy like Terry Smith that I had lunch with last week. He just simply said, no performance fees, no bullshit, which summarized it so beautifully. And Terry Smith's fund, the Fundsmith Global Equity Fund, is now the largest equity fund in the United Kingdom, £24 billion. And if you compare the returns of that fund, for instance, to the South African equity funds, it is criminal how poorly they're performing, yet they defend their position and use all kinds of arguments to protect the way that they run their business, but they are usually profitable.
And I can see why you and Terry Smith actually found each other and swapped notes, because I can see you think the same way. But the second point about Sean's investigation, it's called a feeder fund. And if I'm correct, Magnus, a feeder fund means it's just a conduit. You put your money into it and then they put it into their fund overseas. Is that correct?
That is correct. That applies to all of them.
Okay.
You can't charge a performance fee in the UK or Guernsey or wherever, but you can do it in South Africa.
Oh, that's horrific.
So the feeder fund pays a performance fee, but not the fund on the other side.
So the feeder fund charges its clients, just for being a conduit, a performance fee. In other words, over and above the normal fees that it charges, but the fee that it invests, it takes the funds into. They're not allowed to charge well, they don't, because the competition over there and the regulation presumably is going to stop them from doing it. Now, to me, that's like criminal. It's almost preying on the ignorance of the South African investor.
Well, there's that famous quote in the Richemont book who says something to the effect that those who don't understand will be abused, and that's in many cases the case in South Africa. If you look at the poor performance and the high fees, but the vehement defense of staying local and things will be turning out right, it's quite incredible how poor people are not getting ahead as a result of these factors. And you've now started exposing it. I have tried, but I've tried it on other media platforms. They are simply not interested to publish those kind of figures, whether it's pressure from the advertising departments or the editors having lunch with the media. I don't know, but you just can't get those things published.
Yeah, Magnus, I remember before Warren Buffett turned 80, which is quite a long time ago, at Berkshire Hathaway AGMs, he used to have a press conference on the Sunday, and I got lucky. I got invited to these, I suppose because I came from so far away, and there were only about 30 of us there, and I can remember him time and time again saying to the people the journalists who waited for the Sunday, the day after the Berkshire AGM, you've got to look at costs. You've got to understand that costs are the real issue when it comes to investing. If you are overpaying, the compounded effect of that is massive. And attack these helpers, as he called them, and super helpers, the people who were helping themselves to your money by charging excessive fees. Elsewhere in the world, that message seems to have gotten through. Here in South Africa, maybe not so much just yet, but good luck to Shaun Peche. Do you think he's going to get ostracized by the rest of the asset management industry? I mean, here's a guy who worked for Alan Gray's offshore company, Orbis. He's got a chartered accountant's degree. He's a CFA charter holder. He knows a lot of people worked for an Old Mutual here in South Africa before he went to the UK to go and start his own fund. Do you think they're going to kick him off platforms and take retribution for his expose?
It's going to be much harder to do that on the international side. I mean, Shaun is an extremely clever guy. He's nobody's fool. But what is interesting is that he's been joined by Andrew Lapping. He used to run Alan Gray in South Africa for many years. So Andrew, after his gardening leave of 6 months, has joined Shaun. And maybe you should speak to Andrew Lapping, who's now joined Randmore, which is a small boutique. And so I expect a lot of things from that little company and the way they asset management, they manage money. I'm impressed with them. Our company has investigated them, and we've started putting out some money into that fund purely based on what we see and the direct approach. We do like that kind of approach.
Well, Magnus, stay with us because we're going to be talking about another famous South African in just a moment, Elon Musk. Just to close off on the markets, the Brent crude oil price went above $100 a barrel again today, up by 1%. Gold price steady, $1,752. Bitcoin was up very slightly to $21,481 a coin, and the Geltec crypto basket was virtually unchanged at 419 Rand and 69 cents. So on to that story on Twitter and Elon Musk. It comes from our partners at the Financial Times of London.
Twitter and Elon Musk are still locked in a legal battle. Elon Musk is trying to back out of his agreement to buy the social media site. Twitter's trying to force him to follow through with the deal. But there was a significant development yesterday. Twitter's former security chief, Peter Zatko, came out with allegations that said Twitter misled regulators over its cybersecurity defenses and fake accounts. The FT's Dave Lee says this could damage Twitter's case.
The timing of this is incredibly fortuitous, to say the least, for Elon Musk. Central to his argument of getting out of buying Twitter for $44 billion is that the company has been misrepresenting the number of fake accounts on the platform, the amount of bots on the platform. Now, where Zatko's allegations would be useful to Musk is that he's essentially saying the same thing. He's saying that Twitter executives were being deceptive about the bot problem. They said they may even have misled some of the company's own directors about some of these problems. And so it's almost certain that we're going to hear from Zatko in the trial. And this is now just a collection of pretty serious allegations from someone who's extremely well respected in cybersecurity circles.
So Dave, has Twitter responded?
Yes, they're basically trying to say that this, as a former employee, he's just wrong. And the timing, Twitter said, appeared designed to capture attention and inflict harm on Twitter and its shareholders. So obviously Twitter's trying to draw the link there between the timing of this disclosure and the continuing court battle.
Dave Lee is the FT's San Francisco correspondent.
Lucy, it looks like our FT partners in London have got another big hit there.
They always do, Alec. And I just find myself listening to the Twitter updates and thinking it does feel like a soap opera. What is the share price going to do next in reaction to it? And the tit for tat between Elon and Twitter's board. I feel quite bad for Twitter's board, but, is it deserved? Seeming so.
Well, on the other hand, the shareholders of Tesla will be very happy with this news because Elon Musk has had to sell quite a lot of Tesla shares to get ready for this Twitter deal should it be forced on him by the courts. But he has said that if the deal does not go through, he will take those $10 billion or whatever it is and will buy Tesla shares back. So he'll be back in the market as a big buyer if it goes his way. What do you think? I know you're a user of Twitter, Magnus, but what do you think about this whole Elon Musk versus the Twitter board saga?
He's one of the most colorful characters that we've seen in the business world, if not in the world for many, many years. Of course, he's brilliant and he's proven himself to be the richest man in the world. And I think, as you said, I think this is quite fatal to Twitter's case. Because I listened to some interviews done with this guy. I think his nickname is Mudge. He's been a very prominent hacker and a critic of the way companies handle their security for more than 20 years. And he's been trying to advise, or he has been advising the US government on social media security. And he's been talking about this for a very long time. So it's not fortuitous that he's just broken the ranks and come out earlier this year when he was fired. He's quite an expert in his field, and I think that just about will seal the case for Elon. Our little boykie from Pretoria.
Our little boykie from Pretoria, indeed. He was from Bryanston originally, He did go to Bryanston.
He was.
High.
I always forget to say, I think he came from Four Ways High.
Bryanston High.
Which is about Bryanston High and about 3 kilometers from my office. And from there he went to Pretoria.
But nevertheless, he left Bryanston High because he was bullied and actually badly beaten up. I remember having an interview with his father, Errol, who said that Elon spent 10 days in the Sandton Clinic because he was kicked down the stairs by some bullies at Bryanston High. Not a good thing for Bryanston High and very costly if you think about the support that he could have given. But it does seem, Lucy, like it's the time of the whistleblower. We're seeing this now with Sean Peche. Here we've got a whistleblower, Mudge, as Magnus says his nickname is, who could very well have swung the case in Elon's favor against Twitter.
Alec, we're seeing that trend all over the world. If you think about it, especially it's perhaps a silly example, but the documentaries that we've got coming out on Netflix, they're all about scandals and scammers, and people are being exposed, and people just aren't standing for it anymore. So as much as there's a huge desire to have those conversations, and it's juicy, and the drama is there, certainly the wool is being removed from everybody's eyes intentionally, and it seems that people are seeking that.
Yeah, taking the scales away from our eyes. Well, Magnus, I'm sure you are looking forward to more on the Sean Peche saga. The first one he did on balanced funds, that expose was incredible. Now he's done an even bigger one. We wonder what's around the corner. He's going to be at the Biz News conference where he'll be giving a keynote next week. You're not going to be there this time, but we are going to see you there in March. Look forward to what you're going to be able to share with us there. His final point, though, Sean says the regulator should get involved here in South Africa on this performance fee scam. What's your thought?
Well, I think you should provide a platform to those fund managers to come on and defend their case. They might say, we have a very good case. So we would like to hear the other side of the story, and then the public must make up their own mind. But I wish that public will stop putting the money based on the amount of advertising and not based on the actual performance. And that has been astounding me for a very, very long time. The financial advisor and or the client was very comfortable to invest in a brand name fund, thinking bigger is better, but that has definitely not been the case for a very, very long time in South Africa.
Well, on that point, Lucy, you have been in touch with those named. Any feedback yet?
No feedback yet, Alec. We've engaged everyone mentioned and provided the offer for a right of reply with links. Perhaps people are gathering themselves before they come back to us, and I am hoping that, as Magnus says, that we can provide a platform. I think it's essential conversation. In my own personal experience, I would love to be able to take my money out of funds and just invest them myself, because my performance has been better, and that's literally just in ETFs than I've seen in my pension and preservation and retirement funds. So I'm looking forward to what comes up next, Alec. And that's all for the briefing for today. If you enjoyed this episode, follow Biz News Radio now on your podcast platform to make sure that you don't miss tomorrow's show, where we'll be looking at the freshest market and business updates, including insights into the debate on the return of nuclear power for South Africa.